Trump's called for cutting rates 300 basis points. And I think that's what gold is smelling. And my sense is if they take rates down like that and then maybe even engage in some QE or yield curve control, boy, oh boy, look at the next wave. It's not going to stop at 9%. We've got a big inflationary wave coming. So that's the continued thesis, and that's why we're only in the second or third inning here.
Throughout September, we're shining the spotlight on gold with a lineup of expert conversations, sharp market analysis, and practical investment guidance. To dive deeper, make sure to grab our complimentary gold investing report using the link in the description below.
Greetings to our Wealthion show. My name's Trey Reich, and we're here today with Larry Lepard, Larry the Legend, as some call him, the managing partner of Equity Management Associates. I think his track record and presence in the gold and Bitcoin world are well known to our viewers. So we'll skip on to the fact that we probably couldn't be talking on a more exciting day. The the BLS just released its payrolls estimate for August. The estimate had been 75,000, came in at 22. I think everybody's focused on the revisions of the prior 2 months, which were down a stunning 258,000. If you dig behind today's numbers, we will notice that June was actually re-revised from 147 to the prior 14. Now we're negative 12. So we officially have the first negative payroll print since 2020, which obviously puts the Fed in a bit of a conundrum for their upcoming meeting. And on this news, gold is not touching 3,500. We're now touching 3,600. And silver is 4,130. Bitcoin's 113,000. So in Larry and Mai's world, there really haven't been too many days which have more to talk about than this morning. And so I'm going to start things out by asking Larry, are you most excited at this point in the cycle about gold, silver, or Bitcoin? What are you most excited about?
First of all, nice to be with you, Trey, and I really enjoy talking to you, enjoy your shows. You know, we've been friends for decades. So that's a tough call in the following sense. It kind of depends on what your time frame is, right? I mean, if you want to look at what's really moving right now, what I'm pretty excited about is silver, right? I mean, so silver at $41 is a big, big deal. I mean, taking out $35 was a big deal. I mean, this is a decades long, kind of cup and handle or cup and saucer and handle sort of pattern. And technicians and others will tell you that when you break out of one of these things, you got a long way to run. And so I guess if you ask me just, in the next few months where we're going, I mean, I am way bulled up on silver. I think we're going to 50, 60, 70, this year. I mean, certainly 50 or 60 this year. So that's the kind of the most notable and exciting thing that's happening. Obviously, I'm bulled up on gold and Bitcoin too. I mean, they're both going to move. There's been a pattern. I had a chart that I've shown some people on it in other pods about how gold and silver kind of tend to smell monetary debasement a little earlier sometimes than Bitcoin does, and they move first. And then, of course, Bitcoin suddenly starts to move, and it moves farther or faster. And so, it's a little more volatile, a little more subject to, kind of other things going on, risk assets and stuff. So I mean, in the long run, I'm incredibly bulled up on all of them, probably more, I think and I wrote the book, I'm probably most bulled up on Bitcoin, to be honest with you. I mean, it's very volatile with big drawdowns, but I also think there's a lot of upside. So, but if you're looking at kind of the balance of this year, I mean, I think we closed the year in silver at, I don't know, 60 or 70, which is, I mean, a lot from here. It's like 70 or 8%. I mean, gold, 4,000, it's up another 20, 30% from here. And maybe Bitcoin 140, which is up another 20% from here. So you can see of the three of those, I think silver's got the most excitement. And then I know we're going to get into this. Let's talk about the mining shares, right? So that's just the metal, So if you're a silver miner and, you've been making money at $36 or $38 silver and you've got X amount of profit, well, guess what happens when, and your costs go up with inflation every year. That's happening. We all know that. That's what happens when you take silver to 50. Your profit just went up, multiples of where it was before. And so that's coming. And these silver miners were cheap until recently. I mean, they have run a bit, but, if people, a lot of people have asked me, oh, am I too late? I mean, where are we in this whole thing? And I'm like, no, we're in the second or third inning of this share bull market, in my opinion. So I think there's a lot of upside, and I'm very bulled up on what's going on in the gold and silver shares, right?
So let's break down some of the targets you just mentioned.
Yeah.
So, and I don't mean to press you on this. It's just that
Sure.
we get into these areas where we're at prices that aren't, new ranges for the past couple of years.
Yeah.
Everybody wants to know what's driving it, and am I missing it? Is it too late to get involved? So if we take silver, I think I've probably read 1 million pages on the slingshot effect of silver once it breaks 39. I skip all of that. We're all aware of it. Yeah. And now we're at 41.30. How do you come up with 60 as a target for year end? Are you just looking at technicals, or is that just a conversational comment?
Look, it's a finger up in the wind. As you know, and I don't know. I mean, I could be dead ass wrong. I mean, I don't think it's going to be lower than 45, and it could be 70. I mean, I guess it's probably based on technical analysis, and it's been suppressed for a very, very long time. And all the factors that all those of us in this trade have known for many, many years, I think are becoming more now, you're seeing this shift so that everyone else is beginning to understand those factors. And what are a few of them? Well, one, the solar growth in China is just enormous. Chinese solar panels are now taking 30% of world production, and that's going to grow to 50 or 60% of world production. You've also got these new solid state batteries that are being developed for EVs, not fully commercial yet, but going to be, we think, in the next few years. And they absorb an enormous amount of silver. And then, as you know, Andy Schechtman and all the others have shown us, we've been running these huge supply deficits. We've been, we got grandma melting down her tea set to sell it to the local coin dealer. And, it's just, there's been a chronic shortage of the stuff. And it's a small piece of the price of many of the things that it goes into. So there's silver in your iPhone, not a lot, but there is some. And if that silver price goes up, they could pass it along easily because it's a $1,200 phone. So the point is that there's just a lot of things that are finally kind of coming together. And I think, guessing this, the 60 is a guess. Let me just say that. I don't know, right? But it's kind of finger in the wind technical analysis. And typically when you do break through a support level, you tend to zoom pretty hard. And I think if you look carefully at a chart, you can see some flags and stuff. I mean, it's kind of like gold, gold kind of, squirted up nicely from the 26, 7, 8 area to 3,500, built a really long bull flag at 3,500. It was kind of stuck there for the last many months. And, now it's broken out of that. And so, typical technical analysis says flags fly at half mast. Well, all right. So if it was at 27 and it went to 35, I mean, that's $800. So add $800 onto 35 and you're at 4,003. I mean, I don't know if we'll get there, but I'm pretty comfortable we'll get to 4,000. And interestingly, I mean, the other thing I've really noticed a big change in. I mean, what's driving all this trade? I mean, as we know, what's driving all this is a broad knowledge of the sovereign debt crisis that we're in and how they're trapped and they can't get out. That's what's driving it. And so what are the evidence that everyone's getting it? Goldman Sachs, biggest bank in New York, says, Investment says, we see gold at 4,000, maybe at 5,000 if the Fed loses credibility. Well, okay, that's pretty damn mainstream. And I got to tell you, a year or two ago, gold was at 2,600 and everyone's looking at the stocks and saying, yeah, but it's going back to 2,000. So the stocks are, fairly valued. And I was like, no, it's not. It's going to 3,000 or 4,000. And of course, turns out I was right. They were wrong. And there's a catch up. And the stocks, and we can, if you like, we can show the chart, but the stocks have really lagged, the metal, and we're in the process of closing that gap.
As part of our gold interview series this month, Trey Reich will be hosting a gold investing webinar on Wednesday, September 17th. Send your questions for Trey about gold or gold miners to info@wealthion.com. And Wealthion, together with SCP Resource Finance, will be hosting a global silver conference this October in Toronto. Eric Sprott will be delivering the keynote, and it promises to be a landmark gathering for silver investors. You can find out more in the details in the description below.
So backing up over a couple of things you just said,
Yeah.
Goldman Sachs has been positive, but it was JP Morgan this week who
Did they?
introduced the first $4,025 estimate for second quarter of
Uh,
26, and then by the end of the year they're at 4250. So the fours are coming, as I like to say. But I have always made the comment that I believe in technical analysis when it supports my case. And for folks who want to look at a technical, just textbook example, you mentioned gold consolidating sideways.
yeah.
If you look at how it interacted with the 100-day moving average in the last 2 weeks, it's almost inconceivable that it would be that strong. It's just completely bounced, off that moving average above everything. We're in uncharted ground. So
Yeah, no, we're clearly in it, and
anyone who believes in technical analysis is buying gold with, both pockets. But going back to my original question on silver before we move on to gold, you mentioned the supply demand, and I think all of that's very important, and solar demand, and we've read about the 5-year or so deficit and all that type of stuff. But the truth is that at retail, coin premiums, etc., silver's actually been very soft in the last sort of 3 to 6 months, and premiums on coins are actually into slight deficit. So what I'm leading on to this is, you will agree with me, because I think it's important for viewers to recognize, you can read all you want about the supply demand picture in silver. What has it going through 41 is investment demand. And we're starting to see it at an institutional level. And I think that's very important. It's fine to talk about solar demand. It's all important. It's a great floor. But silver makes its big moves. If it's going to 60, it's not going to be because we sell a couple more, solar installations in China, or the, deficit at the LBMA goes down another 10 tons. It's because institutions and global wealth are starting to look at silver as a store of capital. Do you agree with that?
I think I totally agree with that. I think it's an excellent point, Trey. I would also point out that what makes this thing move so hard and so fast is just how small it is. Okay. We mine 800 million ounces of silver a year. And, at $40 an ounce, I mean, it's just not a lot of money. I mean, in a $900 trillion asset market, 800 million times 40. I mean, what is that? 3.2 trillion. I mean, it's just a small. I'm not even sure I have that right. Let me do my math there. 800 million and 40 times. Yeah, it's 3.2 billion. I'm sorry. I mean, that's a rounding error.
It's a small hedge fund.
Yeah, in most of the world. So if big money decides they want to come after it, it's going to move it. There's just not enough of it out there to supply big money with it. So
okay, now let's move on to gold, because we sort of stepped into that.
I may be wrong on that. That's the 10th. That actually, I think it's 32 billion, not 3.2
32 billion.
But 32 is still a big number.
So now we're into a large hedge fund as opposed to
exactly. A large hedge fund as opposed to a small one. Yeah.
Right. So on the gold side, do you have any feel for where this could go in the short run? I mean, I think everybody understands why you're here. How do we look forward? What are we?
I don't. I mean, higher, but the path is unclear. I mean, the technical analysis says we formed a bull flag at 3,500. As I mentioned earlier, we, flags fly at half mast. We should go up into the fours. As you get further out, a lot of people have asked me, what's your ultimate goal, ultimate target? Where do these things go? And, in my book, actually, there's a chart that was done that shows that, to fully cover, the monetary base with gold, we'd have to have $90,000 ounce gold. Now, you don't need full coverage to have.
When you say monetary base, you mean globally or the U.S.?
I mean USM2 is against what the 261.5 million ounces that we own. But you don't need full coverage to run a gold standard. You can run it on 20%. So, that would imply, I don't know, $20,000 an ounce gold to back the dollar with gold. I think what's very important for people to understand is it's all going to depend on the policy choices on a go forward basis. I mean, what do we do? I mean, what makes this trade not work? And of course, I tell people this, they're thinking of getting in my fund, is if the government suddenly gets responsible and balances the budget. And of course, they laugh hysterically because we know that so far there doesn't seem to be a lot of indication we're going in that direction. I mean, Doge came along. We're going to save 2 trillion, 1 trillion, 300 billion. Oops, maybe we'll save 100 if we're lucky. And then suddenly, the Freedom Caucus is out there saying, oh, we're going to balance the budget. We're going to make these people cut expenses. Well, everyone except for Rand Paul and Thomas Massey caved. And, the big, beautiful bill is going to increase expenses by $300-400 billion a year. Now, that's offset by higher tariffs, which is a good thing. But the point is that the fiscal trajectory of the federal government's a mess, as you know. And as long as that continues, and as long as the Fed is forced into the policy role of monetizing that, which they are in right now, and we just saw some more evidence of that last night. I mean, the Senate has got a really neat trick going on. What he's doing is he's selling short-term bills, 30, 60, 90-day paper, and he's using some of those proceeds to buy the 10-year. So really that's kind of, I call it shadow yield curve control, right? Because he doesn't want the 10-year rate to go up because that will hurt his case for the economy and so forth. So, so we just don't know where we're going to go. We don't know what Trump's going to do. Although we do know from his behavior with respect to the Federal Reserve, and I like to call the Federal Reserve, the real housewives of the Fed these days, given all this, what's going on with the attack on this governor. And of course, what she did was wrong. But, we all
agree that the Fed has clearly become a left-leaning political institution.
Oh, no doubt about it. Absolutely no doubt about it. And
because I don't even think that's up for debate.
But. No, exactly. And Trump's got them on their heels. And furthermore, okay, whether anything changes between now and May's not that far away. We're in September, so count it. It's and we know with high degree of certainty that in May, Trump is going to have a majority of the Fed board and a very dovish Fed governor. I mean, Trump's called for cutting rates 300 basis points. And I think that's what gold is smelling, to be honest with you. I think the reason people might say, well, why now? Why gold? And I think everybody kind of looked at it and go, oh my God, I can see what's coming here. He hates the Fed. He wants to drop rates 300%. He doesn't care about the dollar. They say they do, but they really need a weaker dollar to battle Triffin's dilemma. We know that. And so, the gold says, okay, I get it. Imagine, so it's May next year, a new Fed chairman, they take rates down to 1%. Everybody goes out and refis their home on a HELOC, and we get the next big wave of inflation, right? I mean, it's M2 growth. M2 growth right now, by the way, is running about 4.8%, well above stated CPI. And my sense is if they take rates down like that, and then maybe even engage in some QE or yield curve control, boy, oh boy, look at the next wave. And we're going to, it's not going to stop at 9%. We've got a big inflationary wave coming. So that's the continued thesis. And that's why we're only in the second or third inning here. I mean, if we had responsible people in DC, then I'd look at this and go, okay, well, this has gone pretty far, pretty fast. Maybe we should take some profits, right?
Right. So you mentioned a very important variable that I want viewers to focus on, which is M2 growth, because nobody's talking about it. I have maintained to anybody who will listen to me over the past 3 or 4 months, tariffs are not inherently inflationary. Now, that's such a reactionary comment. we don't really need to debate.
I'll unpack that, but keep going.
But my point is that if tariffs increase the prices of certain goods and money supply remains constant, other prices have to go down because there's only so much money to go around. That sounds, a little academic, but I believe, and that's why we haven't had any CPI type inflation. However, the weak part of that argument is if M2 does start to go up, which it is now spiking, that argument becomes void and we can have inflation. So
and you're absolutely correct.
Because the M2 is really the more important variable right here.
Correct. And you're absolutely correct. And that's the classic monetarist Austrian argument that you can't have inflation without growing M2. However, it's a little trickier than that. And let me just add some nuance to it. Import costs and the price of things that people buy as a result of tariffs are going up. Okay. They are. I mean, now you can say it's not traditional monetary inflation. That's right. But it's higher prices. And so that then finds its way into the CPI. And there's a certain amount of reflexivity in the CPI wherein somebody says, hey, I'm paying more for this, Mr. Employer, you got to pay me a higher wage. Right. And so it's not so simple. So the part of your argument that says, yes, if there's less money in the system, prices come down somewhere else, fine. But first prices go up and some of that stuff you're buying. So it's a mixed bag, but you're right. I mean, ultimately it all comes down to the long term on the M2 growth, and M2 will have to grow. And by the way, I mean, as Lacey Hunt pointed out in a brilliant interview he did recently, tariffs are a tax, and tariffs are actually quite deflationary. And he had a very good comparison to, Smoot-Hawley in the 30s, where, the tariffs were about the same level. They were, 19% back then. They're 18% roughly now, according to the Yale study. And that really slowed down the economy. I mean, big time. Because at the margin, if something's more expensive, people aren't going to buy it. It's just supply and demand. And so if that starts to happen, the tariffs might be the thing that tipped the economy over. And he's worried greatly about the potential for deflation. I see that as an outside case and a possibility. I mean, let's face it, we're heavily indebted, and and it's a credit bubble, and the natural backside of a credit bubble is deflationary. I mean, just go study 1929 to 1935, enormous deflation. What I think is different this time is that we've got this aggressive activist Fed and federal government that has said they're not going to allow deflation to occur, so that the policy response to when this bubble bursts is going to be to print so goddamn much money that your eyes are going to bleed. And of course, that's the thesis of my book. So I've got to talk my book, so to speak. But I think that's what's going to happen. Now, there's some possibility that even in light of that, they fail, and we still get some deflation. But on a price level, because the economy has slowed down and demand is lower, but they'll be pushing as much as they can push on that string. They'll be pushing money into the system, just as they did in 2008, to try and keep the system going. And that will be ultimately inflationary, perhaps with a lag. And in the 2008 case, it wasn't inflationary at the CPI level. It was more inflationary at the asset level. And that's because they started paying interest on excess reserves. So there are a lot of complicated moving pieces here. But I think summarizing it all, Trey, I think the big picture is that in March of 2020, when COVID hit and we really changed all the rules, we literally printed money and sent it out in checks. We gave out PPP, et cetera. We entered what I call an inflationary decade. And as those of us who studied them and even lived through them, because we were kids when it happened, but the 70s I remember well, in an inflationary decade, it continues and you can have waves of inflation. It doesn't really end until you solve the underlying problem. And I don't think we've solved the underlying problem. So, yes, inflation hit a peak of 9. Now it's down to call it 3. But I think we're going to get another wave up. That's my view.
So I'll ask you the least relevant question, because obviously neither of us know. But since the entire world is focused on September FOMC, what do you expect? I assume.
Oh, I don't know. I think
25 pips. I think 50's out of the question. And
I'm with you. I mean, I think Powell's kind of a broken man. I mean, I think Trump has humiliated him. I think he wishes that the data had come in so that he could have stayed a hard ass, because he wants his reputation to be that he's Volcker. But I think even he has to now concede that he's behind the curve, and that the data is telling him he's got to cut. So my gut is he's going to, being the good bureaucrat that he is, he's going to try and play it up the center of the fairway. And if the market thinks 25, he'll give them 25.
And we're going to be looking at 25 a meeting for the rest of the year, that type of
probably
thing.
I mean, December is probably a little bit of a question mark, but I would guess he does that again too. And he says, hey, I'm not caving to Trump. I'm being responsible here, and the data tells me I can do this. Now, I could build a lot of data which say, there's no way you should be cutting, dude. I mean, my auto insurance, my home insurance, my food bill, electricity. I had a great chart I put up on electricity on my Twitter feed a couple days ago. I mean, because of all the AI demand for electricity, stuff's going up. I mean, you live in Massachusetts, it's going up 11% a year. It's nuts. That's not 3.
So one last thing with what you've said already, you mentioned the QE. So we're sort of round QT down to 0. I actually don't even know the current number, but I think it's pretty close to 0. Is that?
I think it's like 5. Well, it's the mortgages plus the 5. So I think it's like 30.
Okay.
Yeah.
So when just generally, how big do you think the Fed's balance sheet will need to get to encumber all of this?
That's a great question. Well, I mean, it depends. Tell me, I don't know, Trey, and you don't either. But I mean, tell me what happens to the bond market. I mean, here's the disaster scenario for the Fed. Okay. People really begin to lose, they don't keep it all under control. People begin to lose confidence in U.S. bonds. I mean, you've asked me what the best investment out there in the world today. Well, it's obviously sound money. The worst investment in the world today are long duration bonds, right? In my opinion. I mean, you're pretty guaranteed that you're not going to get back the purchasing power that you put into them. And so if the market wakes up and realizes that, and the bond market really starts to sell off, then, and we saw in September of 23 that happened, and 12 Fed governors in 2 weeks came out and chirped about how, well, we're done raising rates, because 5% seemed to be a like a threshold line above which they were worried about. And we're at 4.3 or 4 right now. I guess it dropped a little this morning, but if the bond market really starts to sell off, rates start to really jack out, well, then the Fed's going to have to go back to yield curve control. What is yield curve control? It means they will buy the bonds themselves. They're going to fix the yields at a certain level and print the money to do so, or create the money to do so. And, if they do that, I mean, just let's get extreme. I mean, now the 10-year tenor and 30-year tenor are smaller than the Treasury bills or the shorter notes. But if they do that, they're basically going to they could end up having to buy all of them. And so, I mean, not all 37 trillion, because some of them are short-term notes, but all the 10s and 20s and 30s could come to the Fed and say, hey, sold to you. Yeah, you're telling me I can only get 4%, 4.5% in this thing when we've got raging inflation? I don't want to hold it anymore. I'm selling it to you. So, I don't know. Somebody could probably do the math. I'd love to know, actually, what are the total outstanding 10, 20, and 30-year bonds in the United States? Somebody chat GPT that. Tell me. But that all of that could come to the Fed and say, we're not holding it here. You can hold it. And the one thing is, and part of the reason, by the way, why Trump is pushing so hard on the Fed and why he wants this 300 basis point cut, and Bissett does too, and they need it, is that interest expenses are eating them alive. They got a $1.3 trillion interest cost in the federal government budget, and most of that is in the short stuff. And, if they're paying short rates of 4%, if they could take that down to 1%, that would really help the whole budget picture. And so that's what they're trying to do. However, and I said this in another podcast, I went and did the research on it. I found this fascinating. The last time we had yield curve control was in the 40s. And we had it because of World War II. So we're fighting World War II. It's existential. We got to save the world. And in 1942, the Fed came out and said, you know what? We're going to just basically buy all the bonds, short stuff at 3/8 of a point, and the long stuff at 2.5. And so they would not let the bond market fail, and they printed the money to do it. And there was inflation during the war, but we were fighting a war, and we had rationing and all that other good stuff. Well, after the war, in 1947, there was a month where inflation was 18% year over year. And in 1951, there was another month when it was 21% year over year. And why? Because they had pegged those rates at that low rate, and they were printing the money, just like, printing the money in order to keep the rates there. So, can you imagine inflation in the United States of 17% or 20%? I mean, I don't think most people can, but actually I can. And that would really be something, right?
Yeah, I agree. I think the inflection point, the final inflection point for the dollar is, it sounds simple to say this, but I think the Fed's balance sheet's going much larger, and eventually it's just going to hit a level where the dollar, collapses.
Yeah, I actually didn't answer your question, but I think in my book and other places, I've estimated the Fed balance sheet hit a peak of 9, I think, in COVID. I think they've drawn it down to under 7. I remember seeing 6.6 recently. I think on the next time, what does it go to? 14, 15, 20, 25? I don't know. It's big. Bigger. A lot bigger.
Excellent. All right. So backing up a little, we were talking a bit about gold stocks, and I think you have a chart you'd like to share with us of the HUI index, which is sort of the granddaddy of, in one way, gold stock indices. It predates the GDX and the GDXJ.
Yeah.
It's sort of in the same realm as the XAU, which has a lot of copper in it. So HUI is sort of the gold bulls' long-term view of gold equities for those that do not recognize it. And, gold stocks to do well, but I think you hold the view that they're still lagging.
Yeah, let me describe what you're looking at here. This is a chart of the HUI Gold Bug Stock Index compared to the price of gold. And the price of gold is in gold, yellow. and the stock index is in blue, and it starts in early 2001. And so this chart shows you the bull market that occurred in both gold and the right-hand scale is the price of gold, the left-hand scale is the price of Huey. So they're not, apples and oranges, but directionally you get the picture. So you can see in the last bull market that, gold went up a lot and gold stocks went up even more, albeit with a big dip in 08. And then you can see the horrible bear market that we had, from 10 to 15. And then what you can see is, again, the bull market in gold started in 2015 when gold was at 1,050 an ounce. We're now over 35. And this, by the way, this chart's a little out of date. You can see that gold is now over 3,500, 3,600. And the Huey actually is no longer where it is. It's up another couple. It's closer to 500. But the point I'm making is that there's a big gap. And the stocks represent a claim on future gold production. I mean, in a way, a gold company is a miniature sound money central bank. It can produce money, produce gold on a long-term time frame, a stream of gold coming in. And so the blue line should catch up and surpass the gold line if this bull market is anything like past bull markets. And this goes to, this was a much easier call to make in the beginning of 2024, where we're pounding the table. These things are so criminally undervalued. You got to buy gold stocks. And of course, we're up 130, 140% from there. But my point is that there's still a long way to go before we get to the point where, the actual, indices have outperformed the underlying metal. And so that's, in my view, that's coming. And that's why I say we're probably in the third inning of this, gold stock bull. And what the piece here that we really don't know, Trey, is we just don't know where gold is going. At the beginning of this all, these stocks were very undervalued at $2,000 gold, and then, there's a lot of operating leverage in these companies. Their costs go up with the cost of inflation because they have fuel and labor. But, the price of the thing they sell is going up much, much quicker. And so they're all just recording record margins, record profits. And, I don't think it's too late to get in. I will say, though, that, and we're still accepting new money into our fund, but I will say there'll come a time, probably a year or two from now, where we will not accept new money into our fund because this was an obvious trade a year ago and we were balls deep in it. It's still a pretty good trade, but, when things are up 150% from where you bought them, they're not as cheap as where you bought them. And so I think it's going to go further. But there'll come a time when they're fully valued, and perhaps there'll even come a time when they're overvalued. What happened is we went from, I'd say on average in our portfolio, things trading at 4 times EBITDA to now things may be trading at 6 times EBITDA because prices of the stocks have gone up, but the EBITDA has gone up too. And at the peak, they'll probably trade at 10 or 15 or 20 times EBITDA, very much like they did back here in 2011. And at that point, they'll be overvalued. But we're not there yet. I think we've got a couple of years until we get there. So I'm kind of looking forward to a couple of years of good performance in this category because we've really just broken out on a lot of measures.
So, backing up again on something you said, in 2021 and 2022, the gold price, was strong or advancing, but the costs were going up much faster. And so That's something that's really changed here in the 2024. Yeah. So in terms of gold equities, there's been lots of periods where they haven't displayed that beta to bullion leverage that everybody looks for. And I may be getting my years wrong, but 22, 23 was the last example of that. Now that gold has levitated,
let's go back and look at the screen.
We're going to be looking at really, really big increases in cash flows and margins, over the next 4, 5, 6 quarters, even if gold doesn't go up anymore from here.
Yeah, that's exactly right. And yes, you're right. So what you can see here is that, the price started to move and, the stocks moved. It was really 24. The stocks started moving, but it wasn't dramatic. And yes, throughout all this period, gold was pretty flat. It wasn't a huge lag, but it's really more just kind of the magnitude of the move. This just really started to move, and it took a while to kick into the stocks themselves.
So this is a good lead in to your life in the next 2 weeks, because I happen to know you're about to head west to Beaver Creek for a week, where we have sort of the largest small gold investing conference for investors, and then the following week we have the Denver Gold Show, which is one of the two big, in my opinion, institutional investor conferences for gold stocks, the other being BMO, which is cleverly 6 months prior. So it's a big time. And I think viewers should recognize there are going to be numerous announcements from gold companies over the next 2 weeks, because they have a tendency to time some of their news releases to these two important conferences. So that will be interesting to watch. But as you head to Beaver Creek and Colorado Springs, what are you looking for? What do your notes say? Well,
that's a great question. I want to get an update on all these companies. I mean, I talk to managements regularly, but it's always good to see them face to face. And you're right, there are a ton of announcements. I mean, this morning, as an example, we just found Newfound Gold is going to merge with Maritime, which is a completely logical and positive development. We own both of them, more Marathon than Newfound, but they're going to create a very strong producer in Newfoundland. And we will see more of that. I mean, we recently we saw Dundee take over Adriatic, which is a beautiful silver producer, just really starting to ramp up. And Dundee is one of my favorite names. I just love that company, love the stock. I think it's got a lot of upside. I think I've always said, Trey, in my opinion, the sweet spot, there are lots of places to be in the gold stock universe. And unless you know these things well, you should try and stay away from what Rick Rule calls the penny dreadfuls, and stick with, the big known producers, which don't have as much upside, but they don't blow up. And in that bucket, you've got AEM and Alamos and Kinross and, Newmont, Barrick. I mean, it's interesting. Barrick has kind of really underperformed Newmont, and we just took a position in some of the call options on it, the leap call options on it, because I think the valuation gap between Newmont and Barrick is going to catch up. Barrick's going to catch up. And we like Anglo and Coeur and Hecla and all those kind of big names. But the sweet spot, in my view, in this area are what I call just below that tier, where it's a real company with a real mine, with real profits, real growth. It's got a much better chance of growing its production. There are three ways gold companies increase in value. They increase in value when the price of gold goes up. They get a bigger margin. They increase in value when they produce more gold. They're making more of the stuff. And they increase in value when their multiple expands. And so the top tier, the names I just listed, they don't grow a lot because, when you got 5 million ounces of production, it's hard to grow 10%. Adding 500,000 a year is pretty tough, right? And, so the growth isn't necessarily there. They go up when the price of the metal goes up, don't get me wrong. And by the way, they're big and safe, and so most of the institutions own them. And so the multiples, there are very few cheap names in that big category. Although, as I said, I think Barrick is cheap right now. I think it's about 5 or 6 times EBITDA.
Even though it's trading 40% above its 200-day moving average.
Yes, exactly. So what I consider kind of the sweetest category, or what I call just below those biggies, which they're big, they've got production, but they're not so big. Their market cap's not big enough, and they don't have so much production that they can't actually meaningfully grow production. Do you know what I mean? They can add capacity and grow. And also sometimes because they're maybe in not a safest jurisdiction, or they have a little bit of hair on them, they don't get a 12x, EBITDA multiple. They're selling at 4x EBITDA, right? And so the ones that I put in that bucket are, like Eris and B2 and Equinox and Dundee, Galliano, Orezone, Torex, K92, what I call kind of the emerging big producers.
Do you own all of those?
I own everything I'm listing. I own everything I'm listing.
How many stocks do you own in your fund?
Oh gosh, I'm kind of embarrassed to say this, but I'll tell you how we do it. We probably own 60 or 70, Trey. And let me just explain that.
Seems like a high number for you.
Well, it does, but let me explain. It's because of this asymmetry and the optionality in these things. Big names, big weights will be 2 or 3%. We might own 50 bips of a drill story, and you might say, well, why even bother? Well, because as you and I both know, some of these drill stories do 10 and 20 baggers. So 50 bips becomes, 5%, or 10x becomes 5% of the portfolio level, or 10% of the portfolio level. So it's worth owning the 50 bips.
And it's a warning to viewers, it is not a good idea to try to pick one or two of these.
Oh God, no! You got to own a ton of these. I mean, this is all a probabilities game, and you got to know what you're buying when you buy it. I mean, if you're going to own a drill story, you want to own a Banyan as an example, which was trading at $10 an ounce on the ground. Now, and I still own it. I like it. I think it's going to be worth a lot more. But, sorry, viewers, you're a little too late because, I was buying it at 10, 20 cents and it's at 6.80 now or 68 cents now. Right. So
as I recall, they had a mud problem. Do I have that right?
no, you're thinking Victoria. Victoria that's her husband who ran Victoria, which they had a failure on their storage. Their leach pad slipped and it's horrible. But that's different issue. But I mean, the point is that, at each company, you want to know kind of the specifics of, what they've got and how cheap it is. And there were, a year ago, there were just cheap things laying around all over the place and we went and bought them.
Mm-hmm. So are you more excited about Beaver Creek or Colorado Springs? Let's put it that way.
Oh gosh. I mean, both. I mean, you find good things at both of them. And this is, I will say this, Trey, this is one of those areas where being a stock picker really pays because there are, gold mine's a really tough business. It really is. And the Murphy's Law applies everywhere. Costs more, takes longer, harder to do. And sometimes you catch a break. Things come out much better than you thought. Grades are higher, you make more money. But and so it's all probabilities weighted. And so you've got to just weed through the facts and kind of go, okay, is this a good bet or a bad bet? And there's some really good companies, but they're, that are fully priced. And the trick is to kind of try and find the ones that are better than the price is reflecting and to buy them and then hope everyone kind of comes to see that, oh, you're right. That is a lot better company than I thought. But let me just keep kind of going because I know your viewers are probably interested in names and stuff. I mean, so I'm all over silver. I mean, just given what we talked about earlier and the price of silver, man, oh man. I mean, these silver stocks, they should you pick a silver stock, it should double the next couple of years. I mean, if not, if you're only doubling in a silver stock, you're doing bad.
That's one of the problems. There's not many silver stocks.
Well, that's right. So I'm just going to touch on that. There aren't that many pure plays. And even like a Pan American Silver is less than half silver today, although Hecla and Core's got a lot of gold, but Hecla's a pretty pure play silver stock, although they've had trouble up in the Yukon with that.
And Pan American just bought MAG, so they're going to increase.
Yeah, that helps. That's right. Pan American adding MAG and First Majestic, which is less than 50% silver, but they bought Gatos, and that brings them back up into a good piece, and they'll get Jarrett Canyon fixed. In fact, there's a name that's kind of broken, but I think, and the market hasn't really realized the penalty they put on Keith isn't fair in my view. And so I'm still buying it here. We bought some leap call options on it the other day. But silver names, and by the way, a couple of these have run, so I'm not sure I'd buy them here, but that one hasn't run so hard. Avino was one of our biggest positions. Well, it's up 4x, Now I think if they deliver
4x from when?
Let me tell you, I'll just get a thing here. So Avino is 424 and as recently as the beginning of this year, it was 90 cents.
Wow.
Yeah, that was our heaviest weighting going into the year.
Mm-hmm.
Yeah. So, but and by the way, it's not cheap anymore. It's not. We sold some of it, not a lot of it. It's not crazy expensive either. It's now kind of market, bull market perform, and in large part because they're going to really increase their production. I mean, they're at kind of a 2.5 million ounce run rate, and they're going to take it to 6. Which, if they do that and the price of silver does what we think it's going to do, it's going to work fine.
And so I interrupted you. What are your other?
So the Discovery, Endeavor. I think I mentioned First Majestic. Silver Tiger. We like a lot and own that. One that's kind of, I think, stumbled a lot management wise, but has a lot of operating leverage and a high silver price will even make up for the management stumbles is Guanajuato. Own a big piece of that. Don Durrett just kind of profiled that. And then, if you really want to get into kind of the sexy shit that's riskier, several of which probably won't work, but, the kinds of things that if they do work, they're, 5 to 10x your money. I'll kind of give you the developer drill stories that we're in, and you can, futz around with those. And I'm, full of self-interest. I'm on the board at 2 of these. So, full disclosure. I mean, Cabral, I think is a great story and it's going to work. Getchell Gold in Nevada is very undiscovered, very misunderstood. A couple million ounce deposit. Some of it's refractory, but it's easy to make a concentrate, ship it. It's sub $50 million market cap, I think, or it was until recently. And it should be multiples higher. Lavras Gold is a drill story I'm on the board of down in Brazil, 10-kilometer caldera. We think it's got enormous potential, but it's going to take a couple of years to unlock it. Lahontan Gold is another one in Nevada. Again, kind of sub $50 million market cap, 1.5 million ounces. She's taking it to a PEA. I think the PEA is going to show that there's a very economic mine, and so it should be worth a lot more than it's trading at today. Zodiac Gold is over in Liberia, which is actually quite a safe area. It's Western Africa, but safe part of Africa. And, they have just an enormous land package, 20 kilometers by 20 kilometers, and, riddled with gold and iron ore. And I think he's going to develop that in a very nice way. And again, that's like a $15 million market cap. Problem with that one, all these other ones, you can find a US ADR. Zodiac hasn't even gotten to the point where you've got one of those American tickers. You know what I mean? If you want to buy it, it's .vc, so you got to have your Canadian broker get it for you. We like Free Gold as a drill story. We like Heliostar as a development story. I like I-80 a little bit longer term. It's going to take time to develop, but the guy running that, Richard Young, is just a killer. And that thing's
one of my favorites. Incredible.
He's a good guy, right?
Yeah.
You know him, right?
Very serious, yes. Very serious, very sober.
He is going to turn that into an extremely valuable company, but you got to be patient because I don't think there's a lot of, the news flow is going to take a couple of years to come. So we're in it, when it gets closer to really having one of those things going, we'll pile into it. But right now we're just in it.
Yes,
we like Next Gold.
I unfortunately warmed up to that in the low twos, not quite.
Where is it right now? I'm just trying to think.
It's like 90 cents or something.
Yeah. Okay. Yeah. Whatever. $1.12. I got it. Yeah.
So, you're looking at Canadian. So,
yeah. Canadian.
Let me ask you one question because that was a great list, and then we'll spend a couple minutes on Bitcoin. But I have a question for you because you know these companies so well. One of the things I've never understood: Fresnillo operated, one Scipio, is that how you pronounce it? For all these years, they have all this money, they have all this clout, and they own 50% of MAG. Why didn't they buy the other 50%? And why would they let Pan American buy it? I just don't get that.
I agree with you. It's kind of strange to me. I don't fully understand that either. And by the way, I didn't mention Fresnillo when I was going through the silver. It's one of our largest positions. I love that company.
Right. It's almost Newmont of silver.
Yeah, it's kind of it's one of those. I think it's the largest silver producer in the world. It's a little bit family owned.
Silver company, yeah.
Yes.
But why wouldn't that family with unlimited resource? They could have bought it any time in the last decade.
I know. It would have been. Yeah, it would have been pure. Honestly, I don't get it. I mean, as you know, they control it. I think MAG only owns like 40-some-odd% of the economics of Scipio. I mean, I don't know. I don't know.
It kind of reminds me of the whole thing with Ivanhoe. With Oyu Tolgoi, where
same idea.
You have 50%. It's like you don't buy the other half because you don't have to. I mean, is that?
Yeah, same idea. Yeah, I maybe that's it. I mean, I never owned MAG, and I'll tell you why. Because I didn't know what they were going to do with their capital. They were going to. I mean, there wasn't really a growth story there. They weren't going to go start another mine, and so they were going to. And they obviously they get a lot of cash out of that mine, but what are they going to do with it? I like the companies with the most upside, in my view, have proven that they can develop mines like a Dundee, for example, Dundee Precious Metals, and they take that capital and they either do a smart acquisition like Adriatic, or they take the metal and use it to develop other mines that are in their pipeline. Aris, same story. Aris has got a pipeline of 3 or 4 good mines. You can just kind of see. Equinox has kind of done the same thing. You can just kind of see how these are smart people who know how to pyramid and go up. I mean, another one that's actually done it very well too. We don't own it right now because it's just too expensive. Is G Mining. I mean, those people are killers. They did a fabulous. We owned it for a while. We wrote it. I mean, they've done a fabulous job.
And by the way, for viewers, SCP Resource Finance, our partners, are one of the leading financiers of G Mining.
Is that right? Okay.
Big success for
there is no better management team. Mm-hmm. By the way, I mean, I'll tell you what's going to happen. G Mining, by the way, is running out of resources in their flagship mine. Mm-hmm. And they're going to have to come by Cabral. I mean, whether they know it or not, or yet or not, it doesn't matter. I mean,
I'm sure our guys are all over that.
Yeah. What's that?
Nothing.
Yeah.
A footnote. Yeah. I'm sure they're all over.
Yeah, they are.
So let's segue just a bit. We have a few minutes. So
Sure.
Bitcoin, it's 50 minutes into the conversation. We haven't even brought up what I know is one of
I
your
don't
favorite
care.
topics
I'm
in the
good.
world.
I love mining.
So where are we in the Bitcoin cycle? And I know
it's a great
hard
question.
for investors to compare
some people
them.
think,
But if
some
people
think,
look at today's prices on the board, and you look at Bitcoin, and you look at some of these miners, you look at gold, how does Bitcoin play into the whole thing?
well, as I think I've discussed with you before, and as I talked about in my book, I do think Bitcoin will outperform gold. And I think at various points in time, it will outperform the gold miners, not all the time. And it does have one benefit versus the gold miners, and that is that there's really no management team to screw it up. I mean, there are these core developers who sometimes act as though they might screw it up, but fortunately, everybody votes on it. So I think the votes are never going to get put into place to screw it up. So in terms of the cycle, Trey, I mean, there's been a 4-year cycle, and I think that might be getting a little bit elongated here. And my belief is that we're still in an upswing. There's some people who think we peaked at 120 something, 123. I think it's a high. I don't think that's right. I think we've still got another leg to this cycle, and we're kind of consolidating right now. It's interesting to me that gold's moving first. I think my prediction for Bitcoin is we'll be at 140 at the end of the year. If you actually look at a Bitcoin chart, there's kind of a flag right around the 108 to 110 area. And if you project, how it went up from where it went to there to the next move, it should go up another 30 or 40,000, put you at 140. And this cycle, what's the top on this cycle? I don't know. Maybe it'll get nutty up there and we'll squirt up to 200, but then probably we'll correct 50%. I mean, anybody investing in Bitcoin, the biggest risk I always tell people when they're looking at Bitcoin is you have to understand what this is. You have to understand how volatile it is. You have to understand that it's had 50% plus drawdowns. And so, and what'll be sad is we'll get to 150 or 200 even, and some people will finally say, they'll give up and they say, oh, God damn it, I can't take it. I'm going to buy some Bitcoin at 200. And just about then it'll go back down to 100. And then they'll say, oh, fuck, I bought it at the top. I'm an idiot. I should never have done that. And they'll blow it out at 100. That's the wrong move. I mean, buying it at 200 in a 5 to 10 year window is not a bad idea. Buying it at 200 in a 1 year window might be a bad idea. And so, I still feel like we're on the side of it where you can buy it today, comfortably knowing that even the next drawdown probably won't take you below where we are today. I think we're at 112 right now. I feel pretty comfortable that we won't go below that on the next drawdown because I think the next upswing, and this is again looking at technical analysis, and there's something called the power law model. I mean, those of us who are in the space, we use about 5 or 6 different ways of triangulating in on the adoption of this thing. And so, and this is all just guesswork and based on past patterns. But to me, I feel like there's a pretty good chance we'll be 150 to 250 on this cycle. And I think that'll probably occur between December and June of next year. And that at that point in time, everybody will be going crazy. You'll hear Bitcoin everywhere. Your shoe shine guy will be telling you about Bitcoin. All the Bitcoin players will be levered. You'll have all these Bitcoin treasury companies going nuts, right? And then just about then, everyone will be too far on one side of the boat. And we'll get a serious correction, right?
Putting you on the spot, given the volatility that you just mentioned, do you look at Bitcoin as a store of value?
I do, in a long-term sense, in a very long-term sense. I think it depends on your time frame, Trey. I mean, those people, a lot of smart people, gold people who don't believe in Bitcoin say it can't be a store of value. It's too volatile. I get that. That's an argument. It's not unrealistic. I mean, a similar question. I like to compare it to Amazon. Was Amazon a store of value as it was growing, right? It was the leading online marketplace. It just kind of and obviously now it is the leading online marketplace. It would be very hard to displace, right? It's kind of got a monopoly position at the top there. And so it stored a lot of value. In fact, it grew 220,000% in value. So that's the value of a growing network, right? But along the way, in 2008, it went down 90%. And Bill Miller,
just to bring that up, there were 3 drawdowns in a
there have been multiple drawdowns of 50% plus.
And they were 50, 60, and 94 was the third one. Although that was a year and a half.
So I guess probably the right way to classify Bitcoin is, yes, it's emerging to have store of value properties, but right now it's kind of a growth stock. It's kind of an emerging network-based growth stock. That's probably, and so, if in the old world you held bonds for safety and stocks for aggressive growth, in the new world you hold gold for safety and Bitcoin for aggressive growth. How's that as a comparison?
Perfect. So, how do folks get in touch with you about your?
Yeah, so I have a website. The name of the business I run is called Equity Management Associates. The website is EMA2, the number 2.com. There are free newsletters, macro newsletters on there quarterly. You can sign up if you go to the bottom of the site. You can just put your email in. You'll be on the list. We'll never spam you. And that's just a quarterly macro overview and talk about what we're doing in the fund. I'm also very active on Twitter, as most people know. I'm a loudmouth talking about sound money. And then, we should mention, if you don't mind, that I also wrote a book, which
How's the book doing?
That's doing well. So it's called The Big Print. It's available on Amazon. I mean, never written a book before, Trey, and I don't know what to compare it to. I just crossed 40,000 copies sold.
Good for you.
So it's it is good. It's a niche, right? It's a niche financial book. Probably the thing I'm most proud of or excited about. We all know who Robert Kiyosaki is. He wrote Rich Dad, Poor Dad. This will blow your mind, by the way. He sold 50 million copies of that book. Isn't that something? I mean, it came out in 94. I know I read it. It changed my life. It was a great book. He loves my book. He says everybody's got to read this book. So that's a nice endorsement, and I've been trying to use that. So it's coming along.
And for investors who are interested generally in all of this, but aren't quite ready to take the step to Equity Management Associates, we want to remind our viewers that anyone who's interested in having their portfolio reviewed for free should check in with us at wealthion.com/free. And for those who are interested in getting involved in precious metals and they aren't quite ready for Larry's stocks in Burkina Faso, please check in with us at hardassetsalliance.com, where I think we have one of the most user-friendly ways to have our viewers participate in precious metals. So, Larry, this has been great. I'm bulled up on all of these different things, and I look forward to talking with you in a couple of months about everything you learn out west.
Be happy to do it, Trey, and I look forward to that as well. Thank you very much for having me on. Thanks for the time.
Thanks, Larry. Bye-bye.